All right, everyone. Today's video is going to be focused on developing the foundation of a portfolio with a 5-year time horizon. So, like I do when I start all videos, I want to give you all an update of where we currently are in the market. A couple weeks ago, actually last week, we had hit a bottom in the market, and that was in the S&P somewhere around 2200. We bounced pretty hard off of there, and we've gone sideways ever since. So nice big bounce and then sideways. What's really interesting, again, and we do this all the time, is the market was down about 35%, and then from that bottom it bounced up about 20%. And one more time for the fun example, just because when you see the headlines out there, oh, this stock bounced some odd percent. Well, a stock like Penn got teed off on for about 90%, and then it bounced about 260%. So just always keep that in perspective when you're looking at purchasing anything after a big market rout like this. So let's get into the presentation here. I think this is probably going to be one of the more useful, actionable videos that you guys see, so hopefully you enjoy it. All right, so market re-entry strategy. What we're going to be going over is the current state of the equity and bond markets, the fiscal stimulus measures that have taken place over the last 2 to 3 weeks, central bank actions that have been able to backstop a lot of the essential sectors within the country, some of the headwinds that we're going to be facing in the coming 2 to 3 quarters, maybe even over the next year, and some of the tailwinds that are actually going to come of this, because this is not all that bad in terms of, this isn't an end of world scenario. This is just kind of a painful 6 to 9 months. So areas of greatest risk, areas of greatest opportunity, and portfolios. So again, just a quick review, the S&P 500 top to bottom was down about 35%. It bounced pretty good over the last week and a half. Same thing, Dow Jones down 38%, NASDAQ down 30%, and the bonds, municipal, corporate, and treasury bonds, most people understand that bonds don't have as much volatility overall as equities. You could see that here as municipal bonds down about 14%, corporate bonds down 22%, and treasury bonds down 22%. So obviously they all took a pretty big hit, but relative to equities, they've held up pretty good. We're going to get into bonds a little bit deeper later on, why I don't really like them going forward. Not only because we're young and we don't really need them in our portfolio right now, but also because we had about a 40-year bull market in bonds. And if there was ever an opportunity for that bull market to end, this would be the time. 10-year yields, we've talked about this a lot through a lot of our text messages and just chatting amongst each other. Good time to refinance those houses, those multifamilies of yours. Look, again, it's not only where it is at 0.52 as of March 9th. It's been fluctuating around there ever since, but it's the rate of drop. It dropped fast. It dropped hard. And whenever that happens, no matter what direction, up or down, there's always a snapback, and then it always stabilizes. Now, that could happen over the next month. That could happen over the next 6 months. But from here, the probability that 10-year yields go higher and not lower is very high. And also understand this. It's very, very, very unlikely that the United States of America will have bonds, especially the 10-year, go into negative territory like other countries. You can't completely factor it out. You can't assume that that won't happen, but the probability is very low. And so from here, you can make a pretty educated guess and assumption that, especially with a lot of money pumping into the system, inflation will likely go up, and interest rates and yields will likely go up. This is something that's, you'll see this on CNBC, you'll see this on Bloomberg, and so on and so forth. But the track record of the 10-year Treasury yields and the 3-month T-bills is perfect as far as the yield curve and the spread and the correlation is concerned. So whenever the 3-month T-bills, Treasury bills, go up and become more than the 10-year Treasury yields, this is usually a recession indicator. And you don't know if the yield predicts. You can't say the yield predicted the coronavirus, but the inverse had happened back in August of 2019. So, with or without the coronavirus, we were likely headed into some kind of short-term recession. Now, with the coronavirus, we're likely headed into something more. I would say this is going to be a 2 to 3 quarter recession at least. So just this track record remains perfect. If you were ever to do your own research in the future, this is something you should always just take a look at on a quarterly, annual basis just to check where we're at. All right, so let's talk about some fiscal stimulus here. So the response to COVID-19, we had a few bills passed, then they realized none of those bills were going to do anything, and then they passed the fourth bill. So we're talking trillions and trillions of dollars of money that's being pumped into the economy just to backstop it. And what does backstopping mean? It just means so things won't completely fall apart. Liquidity, bank liquidity. Banks depend on mortgage payers to continue paying. If mortgage payers don't get money from the renters, then they can't pay the mortgage. Backstopping that, helping small businesses, helping corporations continue to employ people. This is the type of stimulus that is going on right now. You have to also understand that this is affecting both the supply and the demand side of the equation. What do I mean by that? I mean that they're giving us money in our paycheck. So if you were to be unemployed right now, you would get your normal unemployment benefit plus, say, $600, I think, a week. And then that is kind of helping the supply side. So you're going to get a $1,200 check. If you're unemployed, you're going to be getting a bump up in your unemployment benefit. And that should be helping help with the supply side of things. It's going to help renters continue to pay their rent, homeowners to continue to pay their mortgages. It's going to help people kind of stay afloat, to eat, to spend just a little bit. But the discretionary side of things is going to start tailing off considerably. People are going to buy things they need right now. They're not going to be buying things that they want. And as far as the demand side of the equation, as far as the demand side of the equation goes, you have to understand that we're going to be in a predicament over the next 3 to 6 months, 6 to 9 months maybe, where the demand isn't going to necessarily be there. And because the demand isn't going to be there, businesses need to be backstopped as well. So by giving the consumer a bunch of paychecks and a bunch of benefits, that's great, but they're not going to be spending on discretionary items like they were before. So now you have to help some of the businesses, small, medium, and large, just stay afloat in this time until everything kind of gets back to normal, or what may be considered a new normal. So some of the central bank actions, one of the levers that they use to help inflation and to help the economy is to increase or decrease the lending rate. They currently decreased it all the way down to 0 and 0.25%. That's about as cheap as you can get. This means that banks can borrow very cheaply, investment banks, any kind of institutions that borrow in a very big way. They can borrow very cheap, which means they can lend cheap. That usually stimulates the economy. This is actually one of the reasons why I don't believe that yields can go much lower, because once you start getting your lending rate near zero, I highly, highly doubt again that the United States is going to play the negative rates game. So that's one of the my bearish cases for bonds, is that, well, we're at the point now where you literally can't push yields any lower. And so bond prices are as high as they've ever been. It's because they have an inverse correlation. It's very unlikely that bonds could go any higher from here. And because they've been in about a 40-year bull market, again, the probability is on the side that they go down from here. So we'll get to that in a little bit. But quantitative easing, again, this is the Fed uh, pretty much buying up whatever they can buy up. So they bought 500 billion of U.S. Treasuries. This was suppressing the long-term yields. 200 billion of mortgage-backed securities, which sounds very familiar to the 2008-2009 crisis. And they're doing about 5 trillion of repurchasing agreements. That stabilizes money markets. What that basically does is it kind of ensures that banks can hold on, banks have enough liquidity to hold on to the money you have in your accounts. Also, they're allowing banks to tap into liquidity buffers. So if you remember 2008, 2009, I believe they came out with the Dodd-Frank Act. That act was essentially saying, hey, banks, you need to have a lot more cash on hand to ensure, basically, you need to hold more cash on hand to make sure that when you're lending, that lending is not too leveraged, meaning you're not lending at a 5-to-1. You're lending at more like a 2 or 3-to-1. So right now, the Fed has said, hey, you can tap into that liquidity. So if you need to go past the 2-to-1, 3-to-1, you can start lending at 5-to-1, 6-to-1 again, for the sake of just, again, getting more liquidity into the system and keeping everything functioning properly. And the last thing is they opened credit and funding facilities. What this literally means is that they are going to buy anything and everything from every single sector in the whole entire country. So if you're a oil producer with debt on your books, they're going to buy up some of that. If you're a bank with debt on your books, they're going to buy up some of that. If you're a corporation with high yield bonds, they're going to buy up some of that. They're literally opening what they call these credit and funding facilities, and they're just going to buy up everything. The central bank actually can't legally hold the types of debt that these credit and funding facilities are going to be holding. But again, this is just a way around it for them. But they're going to be essentially buying up all the garbage debt out there to allow companies to essentially take on more debt and to become liquid again. All right. So let's talk about some issues going forward that are not going to be resolved anytime soon. So one of the first ones, you may have noticed that your gas prices have been going down. That is because crude oil is near $20 a barrel right now. It actually dipped below 20 for a little bit, and then it bounced back to, I think it's in the 27, 28 range now. A pretty drastic snapback rally. But just understand that both supply and demand are affected right now. So the supply side of the equation is Russia and Saudi Arabia just essentially trying to pump as much oil into the world as possible. By doing that, they're increasing supply, and that's driving down oil prices. The demand side of the equation as well, we're about to go into a recession. So when you have low demand, that means the price of oil is going to come down as well. So you have a little bit of a perfect storm right now in terms of the situation to suppress oil prices. What this really means too is that small and mid cap energy companies are going to go bankrupt, and the mega and the large cap companies are going to pick up the pieces. So a lot of the small and mid cap energy companies, the producers of oil, can't survive under $30 a barrel for oil. So the longer it goes, it's under 30, and some companies can't survive when it's under 40. So the longer it's under 30 and $40 a barrel for oil, these companies are going to continue to go into debt and they're going to have to go bankrupt. Now, even with the government helping and bailing out some of these companies, they're not going to be able to bail them all out. So you're going to see a lot of the mega and large cap companies buying up the assets at pennies. So these mega and large cap companies are going to get even bigger, control more of the market, but essentially become some kind of, I mean, they're already a little bit of an oligopoly, but become a really, I guess, even a stronger oligopoly going forward. Decreased consumption. So one of the big effects of shelter in place is that we're lowering demand, we're lowering consumption. Consumption is a large part of our GDP, gross domestic product. And so going forward, you should expect extremely suppressed GDP numbers. Normally, a lot of the GDP numbers go into these, huge algorithmic equations that institutions and lending facilities use to shell out money. So the longer we have lower consumption, lower GDP numbers, the less likely that we have any kind of strong growth in our economy. This is going to take some time to happen. This is a little bit of a deleveraging phase uh, in the business cycle, but I would expect that consumption is suppressed over the next 6 to 9 months. The demand disruption. So again, the uncertainty from producers of products and services. Basically what's happening is again shelter in place. Small to medium sized businesses, mom and pop shops, they can't stay open if they're not constantly getting customers on a daily, weekly basis. It doesn't matter how much government assistance and grants and loans are given. These small businesses, uh, they need the business and they need it now. So again, it's very similar across the board. The longer you go without revenue, you only have so much of a rainy day fund, and this rainy day is going to last 2 to 3 months. So most companies can't survive a few weeks without revenue. There's going to be a lot of disruption as far as first demand goes way down, but then what that's going to do, it's going to start making small to medium sized businesses across the board of every sector start going out of business, regardless of, any kind of government bailouts. So the long term COVID-19 effects is just constant unknowns and uncertainties regarding what the new normal is going to look like. This is going to be, it's going to be a paradigm shift as far as how we interact with each other, how we go about our daily lives, how we spend, how we interact with people on a daily basis. And it's an unknown. We don't know how long it's going to last. We don't know if this is going to be like the flu and you just go to the doctor, grab yourself a vaccine and you're good to go. We don't know when the vaccine's coming. We don't know how effective it's going to be. We don't know if we're going to be able to stop the spread with half measures like we have been. So there's just a lot of unknowns, a lot of uncertainty out there. And so this is also a strong headwind because markets always price in future risk. When you have a bunch of question marks in the equation of how do I price in future risk, they just discount it and discount it and discount it. That means you're likely to see companies, even good ones, take a hit just because it's tough to kind of price in what you don't know. So recession is a certainty. There's no doubt about that. We generally have a good idea of how bad the recession is going to be. And what I mean by that is we already started to see staggering unemployment figures. We've already started seeing GDP revisions go down and down and down. We know we're going to be in a recession, but we don't know how long it's going to last. Again, this relates very much to the new normal. When a business is going to feel confident to lend, when a business is going to feel confident to spend. And a lot of that, because it's unknown, we don't know how long the recession is going to be, but you can make a pretty good, you could say it's at least at least 1 or 2 quarters minimum to go into a recession. But this could last 3 to 4 quarters. This could be a whole entire year thing. So, but again, we don't know. Obviously, time helps because you could get more data to kind of analyze. But the recession's a certainty. How long, we just don't know. The bond bubble. So we were talking about this a little bit. And look, with yields going near negative, so the simple direct correlation, well, it's a direct inverse correlation, meaning that when bond prices go up, yields go down. When bond prices go down, yields go up. Well, if yields are likely going to hold above negative, and they're at near negative, they're at near zero right now. Again, this is one of those times where you can say with almost certainty that even if they stabilize around here, that bond prices can no longer go as high as they've went. And we talked about this in other videos, and when I started doing the email chains a while back, that bonds were trading like they were a tech company, like they just cured cancer. Bonds are not that type of investment vehicle. They're supposed to, people who are scared run into bonds. They don't run into bonds, as a way to, as a as an investment that's going to appreciate. That's not the reason people get into bonds. People get into bonds because they need low volatility, they need safety, and they need yield. Well, if you can't go into bonds anymore for yield, and the safety factor is kind of off the table because they're so high, well, now what's the point of a bond? So we're at that point right now. And again, we were in about a 39, 40-year bull market for bonds. They just kept going up and up as yields kept going down and down. If there was ever a time in history that turns, that changes, and we go into a bond bear market, now is the time that would start. Also, just always when I say these things, keep in mind that the United States, the economy, the market, it's the Titanic. Bonds aren't going to just turn into a bear market overnight, but I would expect over the next 6 to 12 months that you'll start seeing lower highs and lower lows and turning this into a bear market. So growth halts. So that's another big headwind. This is obvious, and we talked about this when we talked about decreased consumption and demand disruption. Growth companies aren't going to grow like they used to. So companies that were spending to acquire new customers to grow, that's going to stop. And the problem is that a lot of these companies that do grow at the rate they grow, they don't make any money. So you're going to see a lot more companies really reining in their advertising and marketing spend. And they're going to try to turn into a profitable company during this time, which is all they can do. But just also understand that a lot of companies couldn't, this isn't like Amazon 10 years ago when they just kept growing and they kept telling everybody, hey, we're not worried about earnings. We're not worried about profit right now. We just need to grow. And then all of a sudden, one quarter, they just said to themselves, all right, let's start making some money. And they flipped a switch. And they just started making money like crazy. So a lot of companies aren't in that position. So just understand that growth companies going forward are a little bit more of a riskier investment than they have been. Some of the tailwinds, the Federal Reserve actions are obviously a good thing. Just like in 08, 09, they backstopped the drop. They're going to provide some confidence to banks and corporations, and it's going to be a lasting type of, the Fed isn't going to just throw a bunch of money at the market now and not continue to do it going forward. So you can say with a high probability that the Fed is going to continue to pump money and do what they have to bring back confidence in the markets and in the economy. So how that counteracts with the medical sides of COVID-19 is that if we were to get over the health issues and the health obstacles that are brought about by this virus, If we were to get over that in, say, 3 to 5 months or something like that, and the Fed just kept pouring money into the market to make sure that we were that everything was good, well, that's going to create a tailwind that's lasting longer than the health effects of COVID-19. That's something that's possible. Again, I can't say with any certainty that that's going to be the case, but you can say that that could be a tailwind, especially when they're pumping trillions of dollars into the market. So the effects of the stimulus will be lasting. Uh, on the news and in the tweets of Donald Trump and some of the senators out there, there's a $2 trillion+ infrastructure bill being floated around. Just understand that when rates are so low and you can borrow for free or near free, there is absolutely no reason that you shouldn't just take all the free money you can and spend, spend, spend. If you think that, high debt is a bad thing, just understand that, we're the United States. Where we grow like no other country in the world. We are the biggest, most prominent country in the world. And the debt, even though it's concerning and it's huge, we can print our own dollars. And because we're a fiat currency, we're able to control our currency better than any other country in the world. So the debt is concerning, but if they're going to start, but now is actually the time to be spending, and to be taking on as much debt as possible, because you're taking on the debt at the lowest rates possible. Are you ever going to see rates this low ever again in your lifetime? Maybe, maybe not. But the the fact that we're this low, that we're 0 to 0.25%, you might as well just take all the free money you can and pump it and start making this country as technologically sound, as modern, as whatever you want to make it as possible. And a huge infrastructure bill is a boom in many ways to the economy. And if you've been watching the videos and you understand that I have an affinity for value stocks, it's going to be a massive, massive boost to value stocks. We're talking about energy companies, materials companies, industrials. It's going to be a huge, huge boost. So the other thing too that you need to realize is that with money flowing out of bonds, it's likely going to flow into high yield and value stocks. Again, think of this as the Titanic. It is going to take some time, but if bonds are overvalued and you can no longer get a good yield from those bonds, you need to go somewhere else. And as you've seen in other videos, utilities and REITs were way overvalued. They were going up similar to bonds, just like they were some kind of tech company, or that maybe some biotech company that cured cancer. They went parabolic, and recently they've gotten absolutely hammered. But the point is that people are going to start realizing that when you have value stocks, companies, that the price is below book value, meaning if you were to sell off all the assets minus uh, liabilities, and then all of that's left is less than the current market cap of the company, that's an opportunity. That's a huge opportunity to get in while the price is low. And so there's a lot of stocks out there like that. And so a lot of times you'll see this on CNBC. The S&P dividend yield is greater than the 30-year bond yield. So that's another thing too, is that if the 30-year bond yield, if there's been a lot of volatility in bonds and there's been a lot of volatility in stocks, but you're no longer getting a good yield from bonds, then being in an S&P 500 stock has less risk than it's ever had versus being in bonds. So normally you get into bonds because you want to decrease your risk, but now you have the opportunity to get into stocks which appreciate better over time, and get a good dividend yield. And the risk is less than it's ever been. And again, another tailwind is the government's going to continue to borrow. So the infrastructure bill is one thing, but we have no clue what else they're willing to cook up during this time period. So 2 trillion infrastructure bill could just be the start. As long as rates remain low, they're going to keep borrowing, and that's going to be likely stimulus going forward. All right, so some of the greatest risk sectors here. I'm going to try to get through these quick because I really want to get to the portfolios. So the greatest risk sectors are small to mid cap energy, again, because even with government bailouts, a lot of them can't survive under $30, $40 a barrel for oil. Highly leveraged REITs, especially mortgage REITs. So again, uh, even with the government backstopping a lot of this stuff, there's going to be real estate investment trusts that are highly leveraged that are not going to be able to make it if their renters are not going to be paying their rent. So they're just not going to make it. Unprofitable, high debt growth companies. So companies right now, like application and business software, new IPOs, and biotech companies that depend on debt to survive until they become profitable. It's going to be much tougher for them to operate in this environment, especially over the next 2 to 3 quarters if we're going to be having a recession. Discretionary, so clothing. So if you think high-end retail, even just mid-level retail, clothing and textiles, probably going to get hit. Casinos, absolutely going to get hit. Casino operators and CEOs are some of the most intelligent economists in a way. They know that they need a strong economy to function at the highest levels and to make the most money. They know which switches and dials to turn and press to incentivize people to come. And so one of the issues with casinos is that once a recession hits, they're going to have way less people coming to the casinos. It means that that whole entire sector, so Vegas, is going to get hit. But it's a risk sector right now just because we haven't even really started getting into the recession. But 6 to 9 months from now, it is very, very likely that these are some of the best values in the whole entire stock market. Right now, they're a huge risk, but in the future, they will be definitely an opportunity. Again, utilities and REITs, very likely with bonds to go into about a 3 to 5 year bear market. You're going to see, even though utilities and REITs are more of like a defensive sector, in prior videos you've seen that they went parabolic. The prices just got ahead of themselves. These companies don't do anything except just operate on small margins, pay dividends, and that's it. So uh, the prices just go way ahead of them. So those are likely to go into about a 3 to 5 year bear market, and similar to bonds. Some huge opportunities that are coming up is any company within the infrastructure sectors because of the infrastructure bill. We're talking about aluminum, steel, cement, industrial materials. Companies now with the low debt, high dividend. Again, we were talking about how bonds, because bonds aren't going to be yielding that much, and REITs, utilities, are overvalued. Low debt, high dividend companies going to be definitely sought after in this environment. Regional and investment banks. Here's one of the normally what happens is as rates go lower, banks don't do as well. In this environment, if rates to stabilize and if we get some kind of inflation because of all the stimulus, I believe that regional investment banks are going to do extremely well in that situation. And so they're definitely kind of a sector that we want to look at. New technologies, these are always higher risk. Artificial intelligence, CRISPR and gene editing technologies, robotics, and autonomous software. So we're talking about the software that powers your car that helps it drive itself. Growth at a reasonable price. I like to call this the GARP portfolio. Low debt, 25% plus sales growth over the last 5 years. You want to look for companies that are still going to grow. They're going to be a part of our lives for the rest of our lives. but they're not overvalued and they have low debt. So we're not exactly looking for companies that pay a dividend or pay a high dividend. We're just looking for companies that are continuing to grow and don't need to spend like crazy to grow. So we're talking about Disney, Amazon, Apple, Nvidia, Advanced Micro Devices, you know it better as AMD, Square, and PayPal. And finally, which, we talked about how valuable the energy sector was last year when oil prices were around $50 a barrel. Well, now they're even more valuable. And one of the things I want you to think about is that the price of some of these energy stocks were priced like they were in a recession last year. Okay? And now, because of what happened in March of 2020, they started to be priced like we're in a depression. So we talked about price to book ratio. Again, all that means is that the company is currently valued at less than what the sum of all their liquidated assets minus liabilities would be. So it's a huge opportunity because a lot of these companies, and we talked about this, they pay a dividend. They've been through recessions. They've been through low oil prices. They can survive. They will survive. These are large to mega cap energy companies. These are the ones that there is no better time to invest than right now. And it doesn't mean that you're going to get a huge bounce out of them in the next 3 to 6 months, but it does mean that, at these prices, it is a huge opportunity, especially if your time horizon is 5+ years. So low debt, high dividend, infrastructure, GARP, energy, new technologies. I'm not going to go through those. So, because we already did. Let's get into the portfolios. So let's see. Here we go. So we were talking about low debt, high dividend. So this is Morningstar Advisor Workstation. It breaks everything down for you once you create a portfolio. So I'm going to show you what this portfolio contains. So you have 18 holdings. This is the low debt, high dividend, 25 plus years in business portfolio. It has companies like Big Lots, American National Insurance, Franklin Resources, United Beverages, which is beer, Alliance Bernstein, which is asset management, Comerica, Magna International. So a lot of these companies are related to insurance. These companies thrive in this type of environment. Myers Industries, Old Republic. And so I always base it on $1 million. It just makes it easier to make the numbers look really clean. And one of the most important parts is this. Now you're going to see a lot of this, right? So the S&P 500 is the benchmark, which is the blue. Portfolio is the red line. So everything obviously dipped over the last 2 to 3 months, but know this too is that this portfolio has always underperformed the S&P 500. Where you say, well, okay, Kyle, well, why would I even want to do that? Is that when you talk about business cycles and sector cycles, high growth, and we'll see that in a little bit, has outperformed the market over the last 10 years, while low debt, high dividend companies have underperformed the market. What's also very interesting about that is that the growth companies were outperforming at the same time defensive sectors were outperforming. And so it really left a big hole where high dividend and value companies used to be within portfolios of funds. So over the last 10 years, these companies have been in a bear market. But going forward over the next 10 years, even if you wouldn't expect them to outperform the S&P 500, which is just kind of the market in general, you have a huge opportunity right here to grab yourself 7.23% dividend yield if you were to put this basket together. And so that's huge because right now, these are the companies that are going to survive. These are the companies that are going to be able to make it through a recession. Many of them are going to be able to still pay out that dividend. They're not going to cut or decrease the dividend. this is a great opportunity to get in now, and then over the next 10 years, it may look something like this. So this is the GARP portfolio, which is growth at a reasonable price. So these are the companies you probably know pretty well: Amazon, Alibaba, Apple, Facebook, Salesforce.com, PayPal, Square, uh, AMD, Marvel, and Micron, which are those are two big semiconductor plays. NVIDIA, another semiconductor. ServiceNow, which is a really good software company. So if you were to put this portfolio together, look what this portfolio did over the last 10 years. So as you can see, again, the benchmark is the S&P 500. Look how terribly that looks like it had performed versus this basket. This is the creme de la creme of the market. These are the companies that have outperformed handedly over the last 10 years. These companies have destroyed the S&P 500. And if you were to just get into this portfolio, and this is why we always have the conversations with people, well, hey, I just want to buy the index. Well, look, if you buy the index, just understand the opportunity cost of doing that. You don't have to do a ton of research to be able to outperform the index if you just buy the best companies out there at a reasonable price, right? Growth at a reasonable price. So what you're going to notice here too, and what I didn't go over in the last one, but these low debt, high dividend companies, they fall in kind of the medium size to small size value. Okay. So that's how that kind of lays out. Here, you're looking at mainly large growth companies and small growth companies. And again, look how that has outperformed over the last 10 years. And interestingly enough, the portfolio has a dividend yield of 4%, which is extremely good and obviously much better than bonds. And finally, the last one is the core energy portfolio. What's really good about this portfolio, and you'll see it in a second, so you have all the companies you know all too well: Chevron, Exxon, BP, ConocoPhillips, Halliburton, Schlumberger, Valero, Noble Energy. So these are all some of the best large to mega size oil producers and distributors in the United States and across the world. So these companies have been through low oil, they've been through a recession or two. And what's great about them is you have a yield on this portfolio around 8.48% annually. And look at how it's performed versus the S&P. The S&P has absolutely destroyed it over the last 10 years. So again, you want to be able to layer in, if you were to go back to my presentation and I would click on, let's say, the low debt, high yield. So some of the things I look for here is I'm looking for stocks that are technically in a bear market for the last 5 years, meaning that they've underperformed and they've gone down over the last 5 years. Same thing with infrastructure. I'm looking for companies that are in a bear market. This is a simple business and market cycle play. You're buying low, selling high. To do that, you actually have to look for sectors that have underperformed over the last 10 years, 5 to 10 years even. So these energy companies are at the best value they've ever been. And again, it's not going to turn on a dime. They're not going to go up like tech companies do, and they're not going to do it in an immediate fashion. But these are companies that are not going to go out of business. They're going to pay you a dividend. And similar to some of the growth at a reasonable price companies, they are going to be a part of our lives for the rest of our lives. They're not going anywhere. So, all right. Well, I hope that was helpful for everybody. If you have any questions, shoot me an email. I know this was a long video. I always try to keep them short, but I always ramble on. So I hope you guys got something out of this. And again, if you want any help putting together a portfolio for yourself for the next 5 to 10 years, please let me know. I'd be more than happy to help you guys out. All right. Have a good one.